Credit score. Understand what it is. Imagine two people walking into the same bank on the same day applying for the exact same loan. One of them walks out with a 4.5% interest rate. The other walks out paying 11%. Same bank, same loan amount, same day. The only difference, a 3-digit number. Not their salary, not their savings, not their character, just a number. And that number was not measuring what most people think it measures. That is exactly what we are breaking down today. Because once you understand how this system actually works, you will never see credit the same way again. Here is what nobody tells you when you are first learning about credit. The score is not the point. The score is a symptom. It is the result of a set of behaviors, decisions, and timing choices that most people make blindly, without ever understanding what the system is actually rewarding or punishing. And because nobody explains the rules clearly, most people spend years making decisions that feel responsible, that look responsible on the surface, and that quietly work against them underneath. Think about how many financial decisions in your life are directly connected to that number. The apartment you applied for, the car you financed, the insurance premium you pay every month without knowing it was calculated in part from your credit behavior. The job you almost did not get because the employer ran a background check that included your file. Most people connect credit to loans and stop there. The reality goes much further than that, and the cost of not knowing exactly how far it goes is not abstract. It shows up in your bank account, in your monthly expenses, and in the options that are available to you versus the ones that are quietly closed before you ever get to the door. What we are building across this content is not a list of tips. It is a complete understanding of how the credit system actually operates from the inside out, not how it is marketed, not how it is simplified in a 2-minute explainer, how it actually works mechanically, legally, and strategically so that every decision you make from this point forward is one you understand before you make it, rather than one you regret after. The people who consistently hold scores above 800 are not smarter than everyone else. They are not wealthier. They do not have access to information that is hidden from the general public. They simply learned the rules of the game before they started playing it. And the rules are learnable, every single one of them. That is exactly what this is for. The number that controls more than you think. Most people treat their credit score the way they treat their blood pressure. They know it exists, they know it matters, and they check it occasionally when something forces them to. But they have never actually sat down and mapped out everything that number is, quietly influencing in the background of their financial life. That gap in awareness is expensive. And the first step to closing it is seeing the full picture all at once. Your credit score is not just a lending tool. It is a gatekeeping mechanism that operates across 4 major areas of your simultaneously, and most people only know about one of them. Lenders use it to decide whether to give you money and at what price. Landlords use it to decide whether to give you a place to live. Employers use it to decide whether to give you a job, particularly in roles involving financial responsibility or access to sensitive information. And insurance companies use a version of it to decide how much to charge you every single month for the coverage you already have. 4 systems, 1 number. Most people only see the loan piece and assume the rest does not apply to them. It applies to all of us. Here is what makes this more serious than most people realize. The difference between a good credit score and a mediocre one is not just a matter of percentage points on a loan. Over the life of a 30-year mortgage, the difference between a 4.5% rate and a 6.5% rate on a $300,000 home is more than $130,000 in additional interest payments. That is not a rounding error. That is a car. That is a college education. That is years of retirement savings. The number does not just open or close doors in the moment you apply for. It determines the price you pay for those doors for decades. The score itself is built from 5 components, and understanding the weight. Each one changes how you prioritize every financial decision going forward. Payment history carries the most weight at 35%. How much of your available credit you are using, which is called utilization, accounts for 30%. The length of your credit history contributes 15%. The number of new accounts and recent inquiries makes up 10%, and the mix of different types of credit you carry fills the remaining 10%. Those 5 numbers are not equal, and that inequality is exactly where most people make their first strategic mistake. They focus on the wrong factor and wonder why the score barely moves. What this means in practical terms is that a single missed payment, one bill that slipped through in a difficult month, can do more damage to your score than carrying a high balance for an entire year. That is not an opinion. That is how the model is weighted. And once you understand that, you stop treating all credit behaviors as equally important and start making decisions based on which factors carry the most consequence. The system is not designed to be obvious. It is not designed to be fair in the way most people use that word. It is designed to predict behavior, specifically the likelihood that you will repay money that is lent to you. Everything the score measures is in service of that one prediction. When you understand the prediction it is trying to make, you understand why it measures what it measures, and you stop being surprised by the way it reacts to decisions. The number that feels like a verdict is actually a reflection, and a reflection can be changed, but only if you know what you are looking at. The next thing most people get wrong is thinking they only have one score to worry about. What you are about to learn changes that assumption entirely. FICO versus Vantage score. You might be measuring the wrong thing. You checked your credit score this morning. It said 720. You felt good about it. You went to apply for a mortgage this afternoon and the lender pulled it came back at 681. Same person, same credit file, same day. Two completely different numbers. And the one that mattered was not the one you checked. That scenario is not rare. It happens to people every single day, and the reason it happens is something the credit monitoring industry has very little financial incentive to explain clearly. There is no single credit score. There are dozens of them. But the landscape is dominated by two major scoring systems, FICO and they are not interchangeable. They are built by different companies using different formulas weighted differently and designed with different end users in mind. Treating them as the same thing is one of the most common and most costly assumptions a consumer can make when preparing for a major credit application. FICO, which stands for Fair Isaac Corporation, has been the dominant scoring in lending for decades. Approximately 90% of top lenders in the United States use a FICO score when making credit decisions. That number alone should tell you everything you need to know about which deserves the most attention when you are preparing for a loan application. FICO scores range from 300 to 850, and they come in multiple versions. FICO 8 is the most widely used general-purpose version. FICO 9 treats medical debt more favorably. FICO 10 and 10T incorporate trended data, meaning they look at how your balances have been moving over time rather than just where they sit today. Mortgage lenders specifically use older versions, FICO 2, 4, and 5, which are pulled from Equifax, TransUnion, and Experian, respectively. Those versions weigh factors differently than the newer ones, which is why your mortgage score can be meaningfully different from the score on your Vantage score. Was created in 2006 as a joint venture between the three major bureaus, Equifax, Experian, and TransUnion. It also ranges from 300 to 850, and it was designed in part to score consumers who do not have enough credit history to generate a FICO score. Vantage score requires only 1 month of credit history and one account reported within the past 2 years to produce a score. FICO requires at least 6 months of history and at least one account reported within the past 6 months. That difference matters enormously for people who are just beginning to build credit or who have thin files. Here is where the practical problem lives. Most free credit monitoring services, the apps you check on your phone, the score that appears on your bank's website, the number that comes with your credit card statement, the vast majority of those scores are Vantage score, not FICO. They are useful for tracking general trends and catching sudden drops that indicate fraud or an error. They are not accurate predictors of what a mortgage lender, an auto lender, or a major bank will pull when you submit a formal application. The gap between your Vantage score and your actual FICO score can be anywhere from a few points to several dozen points in either direction. And when that gap, lending tier threshold, it costs you real money. The lending tier thresholds are where this becomes financially consequential. Lenders do not offer one rate to everyone above 700 and another to everyone below. They operate in bands. A score of 760 and above typically qualifies for the best available rate. A score between 720 and 759 qualifies for the next tier. Drop below 720 and the rate increases again. Below 680, the increase becomes significant. A consumer who optimized their Vantage score to 738 believed they were in the second tier and then discovered their FICO was 714 at the moment of application is sitting in a lower tier without having realized it. The rate they are offered is higher than the rate they prepared for. The solution is not complicated, but it requires knowing where to look. Several credit card issuers provide access to a genuine FICO score as a free benefit. Discover provides FICO Score 8. American Express provides FICO Score 8. Some Bank of America accounts provide access to a FICO score as well. If you have any of those cards, you have access to an actual FICO score at no cost. For mortgage preparation specifically, some lenders will provide a tri-merge, showing all three bureau FICO scores during the pre-qualification conversation before a hard inquiry is triggered, which gives you the most accurate picture of where you stand before anything is formally submitted. Know which score you are looking at, know which score the lender will pull, and make sure the number you are managing is the number that actually decides your outcome. Most people who understand the scoring model still make a critical error in how they monitor their file, and that error often allows damage to sit undetected for months before they ever realize it is there. The credit invisible, what having no score actually costs you. There is a category of person that the credit system does not just penalize, it ignores entirely, and being ignored by this system is in many ways more limiting than having a damaged file. At least a damaged file exists. At least a lender can look at it and make a decision. When there is no file at all, the decision is already made before you say a single word. The answer is no. And the reason is not anything you did wrong. It is simply that you never existed inside the system to begin with. Approximately 45 million Americans have no credit score. Either their file is completely empty, or it does not contain enough information for the scoring model to generate a number. The credit bureaus call this being credit invisible. And the cost of that invisibility is not theoretical. It shows up the first time you try to rent an apartment without a cosigner. It shows up when you apply for a car loan, and the only options available carry interest rates that a borrower with an established file would never accept. It shows up when you try to get a cell phone plan without a deposit, or apply for a job that runs a background check, or attempt to build any kind of financial foundation that the modern economy assumes you already have. The common assumption is that having no credit is better than having bad credit. That assumption is wrong. A lender looking at a damaged file can at least assess the nature and age of the damage. They can see whether the problems were recent or years old, whether there has recovery, whether the negative items are isolated or part of a pattern. They have something to work with. A lender looking at an empty file has nothing. There is no history to evaluate, no behavior to analyze, no signal to. From a risk assessment standpoint, the absence of data is treated as the presence of risk because there is no evidence of responsible behavior anywhere in the record. The path out of credit invisibility is specific, and the order in which you take the steps matters more than most people starting from zero understand. The first move is not to apply for a credit card. The first move is to check whether a file already exists in your name. Errors, fraud, and mixed file situations can create records you never knew about, and those records may already contain negative information. Checking annualcreditreport.com to pull all three bureau files costs nothing and takes minutes. If nothing exists, you are starting clean. If something exists, you need to know what it contains before you take any action that adds to the file. Once you have confirmed the file is empty or thin, the fastest legitimate path to building a scorable file runs through three tools used in combination. A secured credit card is the foundation. A credit builder loan accelerates the process, and becoming an authorized user on an account belonging to someone with a established file can add immediate positive history to your own record. Each of those tools works differently, and each one addresses a different component of the scoring model simultaneously. A secured card establishes revolving credit history, which feeds into payment, history, and utilization. A credit builder loan offered by many credit unions and community banks establishes installment credit history, which feeds into credit mix and payment history simultaneously. The loan works by holding the borrowed amount in a secured account while you make monthly payments, then releasing the funds to you when the loan is paid off. You build credit history without taking on actual debt risk in the monthly payment record appears on your file the same way any other installment loan would. An authorized user addition works by attaching your name to someone else's, allowing the age, payment history, and utilization of that account to appear on file as if it were your own. Used correctly, a single authorized user addition on a long-standing account with a clean history can move a thin file from unscorable to scorable in one reporting cycle. The timeline for building a file from nothing to a genuinely competitive score. Typically 12 to 18 months of consistent correct behavior. Not years, not a decade. 12 to 18 months. The people who take longer are usually the ones who made avoidable mistakes in the early stage, opened the wrong accounts, used the secured card incorrectly, or applied for too many products at once before the file had enough positive. Absorb the impact of hard inquiries. Starting from zero is not a disadvantage that lasts forever. It is a temporary condition with a clear path out. The mistake is not knowing what the path looks like before you start walking. And the first tool most people use to start that walk, the secured card, is also the tool most people use completely wrong. Here is where most people stop. They hear the word secured card, they feel like they understand the concept, and they move on assuming the hard part is over. It is not. Opening the right account is the easiest part of this process. What happens after that, specifically what you do in the first 30 days, the first 3 months, and every single month after that, is where the real difference gets made. And the way the majority of people use this tool guarantees that it produces a fraction of the result it is capable of producing. There is a specific pattern of behavior, a very particular sequence of decisions around how you use the account, when you use it, how much you charge, and exactly when you pay. That determines whether this tool builds your file the way it is supposed to or quietly stalls your progress while you wonder why nothing is. Most people never learn that pattern. They find out it existed only after they have already spent 12 months doing it the wrong way. That is exactly what the next part of this series covers, along with 2 other strategies that most people building or rebuilding a file never think to use, both of which require nothing new. No new accounts, no new debt, and no new, just a different way of looking at something you are already doing every month. If you have been paying for housing, you already have more credit building leverage than you realize. The next video shows you exactly how to use it.